fast-moving consumer goods or FMCG companies have had a mixed show at the bourses over the past 3 months. While the benchmark Nifty 50 index dipped 0.4% during the period, the Nifty FMCG index has slipped 2%. Among stocks, shares of Britannia Industries, Hindustan Unilever, and ITC have declined in the range of 4 to 9%. The drag, analysts believe, has been due to muted rural demand, late onset of festive season, erratic weather conditions, and increased competition from local players. The recently announced September quarter results of Nestle India too reflected the trend. The company's total sales growth came in at 9.4% in Q3 CY23, down from 15% in Q2 CY23 and 21% in Q1 CY23. The management, however, remains hopeful of volume recovery amid better demand trends across Tier 2 and 3 cities and pricing and volume mix. Analysts too expect the trend to percolate across the sector.
August rains has been a spoiler, El Nino has been a spoiler, but overall margin recovery remains good. Only one issue is crude is now back to $90. So that is a slight worry from a commodity inflation now coming back. If crude goes beyond $100, that's a bigger concern. At 90, it's a slight concern, I would say. So our topics currently will be Nestle, Tata Consumer, Godrej Consumer, and Colgate.
On October 18, the central government approved a 4% hike in dearness allowance for central government employees. The decision, which is expected to benefit over 10 million employees and pensioners, comes with the onset of festive season. Analysts believe increased disposable income would further support demand recovery. That said, volatile commodity prices, including that of crude oil, may play a spoilsport. According to G. Chokhalingam of Economics Research, FMCG companies may not entirely pass on increased input costs as the industry volume is growing in poor single digits. Any significant price hike would suppress volume demand further. Markets for now are closely monitoring commodity costs and are partially factoring in margin contraction for companies heavily dependent on crude oil derivatives. Against this, what should be investors' strategy?
We are expecting second half to be better than first half, and that would be driven by the upcoming festive season, which will drive demand growth, as well as rural will see some pickup. FMCG being a defensive play, investor strategy should be to invest in staggered manner in FMCG names like ITC, HUL, Marico, and Jyoti Lab.
In a nutshell, the FMCG sector is eyeing a gradual recovery in demand led by moderating inflation, a hike in minimum support price, and government spending. A stock-selective approach, however, is advisable given volatility in commodity prices. On 20th October, markets will react to the Q2 results of HUL and ITC. Hindustan Zinc, JSW Steel, and Paytm will be among the 55 companies which will report their September quarter results.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's making plans for an early retirement. Business Standard.